Welcome, FBS 705 class, to this next online lecture in this valuation series. Today we're going to be looking at video 2C and we're going to unpack determining the enterprise value using a sales multiple. To provide a little bit of context as to why we would look to use a sales multiple, we established previously that a EBITDA multiple is optimal in the sense that it represents our cash flow. All right, we look at the earnings before interest, before tax, before depreciation, and before amortization. So we're determining the value of a company based on its cash flow. We then separately deduct my market value of that particular debt to get the value of equity. However, the question now arises is what happens if a company has a negative EBITDA multiple? All of a sudden, we can no longer use the EBITDA approach. This is where the sales multiple comes in, and it's used when there is ordinarily a negative EBITDA figure. And we determine the value of an enterprise based on its sales multiple. The question you may ask yourself is, why would anyone want to invest in a company that has got negative EBITDA? Well, obviously there's more strategic reasons to go into it, but if you look at a company that is again coming to the fore, has already come into the fore in South Africa, is Takealot. Now, I think I might have shared with you previously, but Takealot has yet to make a profit in the South African market. Yet, this company would have an embedded value. Why? Because of its distributions chain and as a result of it being at the forefront of online sales in South Africa. So, how does the sales multiple work? It works in the same way as any other multiple. The only difference now is that instead of, for example, using my EBITDA figure, I'm now using my sales multiple. I use this multiple to determine my value of operations. Once I've got that, I add my dissimilar assets and surplus cash. These must be valued separately. Why? Because they have a different risk profile. That provides me with my value of the entity. I then deduct the fair value of my permanent debt. In other words, that debt that forms part of my capital structure. Just be wary. If I've got, for instance, an overdraft that is a permanent source of finance, that must also be included in this part. And then that gives me my fair value of equity. How did I determine my sales multiple? Value of operations divided by sales, and that gives me my multiple that I then use to multiply by at a later stage when I'm determining the value. Importantly, as I said and as I established earlier, that this is used where the company is loss-making, in other words, or it's a new entity such as Takealot coming into the environment where a market does not necessarily exist at that particular stage. All right. As with the EBIT and EBITDA multiple, it eliminates the effect of capital structure. Why? Because I'm valuing my operations. And then we established above, value separately, dissimilar assets and my surplus cash. All right, so that is the sales multiple in a nutshell. We follow the same process as we would normally follow with a normal multiple-based approach. Let's have a look at an example to unpack this in a little bit of detail and put some contextualization to the theory that we've just highlighted. Let's now turn our attention to lecture example 3. This is a separate handout that you guys will be able to find on ClickUp. This represents and this illustrates the sales multiple effect and how to use this in a given scenario. What I would like for you to do is I'd like for you to please pause the video at this stage, and I'd like for you to try and attempt this particular question on your own. Remember, key thing to focus on is that the methodology remains the same. However, instead of using an EBITDA approach, instead of using my EBITDA figure to determine my multiple, I'm now simply using my sales figure for that amount. Please pause the video and we'll go through it shortly. All right, hopefully you've all got your answer. Let's run through this particular question together. Once again, we're looking at Smoothies Limited. If we quickly go down to the required, determine the fair value on a per share basis for the shares of Algon using a sales multiple as the basis for the calculation of the value. Now, information remains relatively similar to some of the previous examples. I think lecture example 2 that we went through together. But we've got this company, Smoothies Limited, and they are interested in buying Algen. All right, Algen has got this information that's available for 2019, 2018, and 2017. All right, and they've given us the revenue, after-tax figures, etc., etc. Fair value of Algen debt on 31 August amounting to 80 million. Now, why is this important? Well, remember, we're trying to determine the value of equity. However, when we're using EBIT, EBITDA, or my sales figures, I am determining the value of the enterprise. Not the value of equity, the value of enterprise. And the reason why we know this is because we have not yet deducted or removed interest or tax. As a result of this, it would represent the value that the enterprise generates. And that's why it determines the value of the enterprise. So we know that in order for us to go from the enterprise value to the value of equity, we need to deduct the fair value of my debt, which is this 80 million. The company has cash surplus of 10 million. Why is that important? We know that is a dissimilar asset. And it owns 1 million shares in a company in liquid fruit, and this company had a dividend of 400,000 on 31 August, and it's got a constant growth of 5 and a cost of equity of 11. Then we know that there's another similar company to Algen that is called Apple Spritzer. Same information that there's been previously. The following data relates to the company as 31st of August 2019. Company shares, they're 100,000 issue. They were trading at 6 Rand per share. And the company's debt was a fair value of 200,000. Apple Spritz has investment in cash, again, dissimilar asset of 44 million, with revenues amounting to 94.5 million. Obviously, we need that revenue figure in order for us to determine the multiple value. So what would be the first step? If we're trying to determine the fair value, what would be the first step? Well, we know we need to break it up into different components. We need to have my maintainable revenue as one component, and we need to have a multiple to use in our computation. So let's go through and let's determine the multiple first. We're going to be basing this multiple on Apple Spritzer Incorporated. So what do we need to do? We need to determine what that sales multiple is. So we need to get firstly the market value of Apple Spritzer. So to determine the market value of the entity, it consists of both equity and debt. The equity component is going to be my 1 million shares in issue multiplied by the $6 per share. And to add that, we need to add the 200 million. And that gets me to a value and an enterprise value of 400 million. However, as part of that enterprise value, what do I know? I know that included in that 8 million is a dissimilar asset of 44 million relating to cash and investments. So if I'm determining the value of my operations, which is what my multiple represents, as we did in lecture example 2, I need to make sure that I deduct that out to get my value of operations as 758 million. Once I've got that, I divide that figure by my revenue to get my multiple at 8. Now, once I've got my multiple at 8, that takes into account my comparable listed entity. The next step is I need to adjust for known differences between Apple Spritzer and Algen. So yes, this is a similar listed entity, but I still need to make those once-off adjustments. So what adjustments do I make in this example? The fact that Algen's unlisted, much smaller than Apple Spritz, and you can put a couple more points down there if you deem them to be necessary. However, when you make these points, just try and make sure that you try and limit it to information from the scenario. Often we find that students provide a long list of these points as a shot in the dark, so to speak. So just rather try and make sure that those points are relevant to the scenario. So what we've got here is we're reducing my multiple for the fact that it's unlisted and the size effect, and we get a multiple of 3. So that means that the multiple that I can use for my valuation is 3. Step 1, done. Now I need to go to step 2. And step 2 relates to the revenue figure. But can I just go and take last year's revenue figure as 100 million? Would that be fair? Well, no, it wouldn't. And the reason why it wouldn't be fair is I still need to determine whether or not a trend exists. Remember, I'm focusing on maintainable revenue. Does a trend exist, yes or no? Is it a continued upward trend? Is it a downward trend? Or do I need to take an average over the last 3 years? So in this example, what do? I outline my revenue, 80.8, 80.9, 100. I can see it's going up. I can see it's going up reasonably the same each and every year. So it's an increasing trend. So therefore, I know my 2019 figure is deemed to be maintainable. In other words, it'll increase like that into the future, takes into account that growth. So if I want to calculate the determination of value, I've now got my revenue figure of 100, and I've got my multiple of 3, one multiplied by the other to get my value of operations as 300 million. Importantly, and I think this is something that is worth discussing at this stage, if I'm looking at my revenue figure, I now know that I've got other dissimilar assets. Do I need to adjust my revenue figure for anything relating to those assets? Well, to answer that question, it all depends. As in FPS, everything depends. And it depends on whether or not anything relating to those dissimilar assets is included in my revenue figure. Let's say, hypothetically, I am determining, and I'm using a sales approach to determine the value of a financial institution or a bank. Okay, yes, in that particular example, my investments in operations or surplus cash would probably be part of my cash flow. But just from a theoretical standpoint, if it was separate and it was included in my revenue figure, if I do not adjust that particular component out, I'm going to overstate the value. I don't want to be in a situation where I'm double counting both revenue and adding separately the value of a investment or cash surplus. So if anything relating to the dissimilar assets is included in my revenue, I need to strip that out so that only the revenue generated from the core operations is included in the multiple. All right, hopefully that all makes sense. So add back, as we did in that previous lecture example, add back the value of investment using my dividend discount model to get me a fair value of 7, add back my cash surplus value of 10, which means the value of Algen Enterprises is 317 million. If I want to get the equity, I've got to deduct the fair value of my debt. That gets me to my value of equity as 237 million. Divide that by 10, 23.7, and there's your uncle. It's the same as was for lecture example 1. All right, I hope that makes sense to you and that you understand how the sales model works, number 1, and number 2, when we would use it in an example. Summarize, we'd use it when company has a negative EBIT or EBITDA figure and we want to determine the value of the enterprise, number 1. And number 2, where we have a new market. As a result of a new market, new trends, company most likely isn't making a profit in that same boat. This brings us to the end of lecture video 2C relating to the sales multiple. I do want to apologize at this stage if you did hear my daughter in the background. Life happens. Cheers for now.